Hello, everyone, and welcome back to the Deep Dive. I hope you're having a fantastic week and are ready to go deep with us. Today, we're cracking open one of the most durable yet deeply controversial companies in financial tech, Intuit. On the surface, it's a fantastic business, a fortress with a powerful brand. But the real question for us is this: are there hidden cracks in that fortress that the market is ignoring? That's what we're here to find out.
That's a massive question. And before we get into the details, just a quick note for everyone listening.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use Interactive Brokers, and we've partnered with them to get you a stock bonus when you sign up.
So you get a bonus and support the show at the same time. That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know is to subscribe and like. It truly helps. And if you have any questions, please manifest in the comment section.
Perfect. Now let's get into it. Let's start with that fortress you mentioned, the undisputed good part.
Exactly. How does a company like Intuit generate almost $19 billion in revenue? And, why is it so resilient?
Well, it's all rooted in necessity.
Mm-hmm.
At its core, Intuit is it's a surprisingly simple two-sided platform.
Covering things people can't really avoid.
Precisely. On one side, you've got the growth engine. That's Global Business Solutions, or GBS. It's mostly subscription revenue from QuickBooks Online.
And QBO is so much more than just a ledger now. It's basically the whole operating system for a small business.
It is. It's an entire ecosystem with payroll, payments, and, of course, their huge Mailchimp acquisition for marketing.
So it's riding some big trends.
Two unstoppable ones, really. The big shift to cloud-based finance and the explosion of the solopreneur, the freelancer who needs real tools. That GBS segment is guided for, 14 to 15% growth.
A very robust number. And then there's the other side of the platform, the cash-gushing giant.
The consumer platform.
Right.
And that's all about TurboTax. It's incredibly profitable. I mean, it basically dominates the do-it-yourself tax market by selling confidence, relief from anxiety.
And they've become experts at upselling people.
Oh, absolutely. Pushing them to TurboTax Live, connecting them with human experts, which is just a huge high-margin boost.
Yeah.
And then they bolted on Credit Karma for $7.1 billion.
Which is a lead generation machine.
For its 129 million members, yeah. The endurance of the whole model is it's impressive.
Because it's non-discretionary. Nobody stops filing taxes in a recession.
It's the definition of a necessary expense. But the real defense here, the economic foundation, is the high switching costs.
So how do we actually test that? What's the proof that small businesses really can't leave QuickBooks?
The proof is in their pricing power. It's what we call the Roach Motel test. They can raise prices aggressively, customers get furious, but they're forced to just take it.
You have the numbers on that, right?
I do. QuickBooks Online Plus went up over 64% between 2020 and 2025, the advanced plan, up 83%. They even tell investors that their growth is from higher effective prices.
Wow. Hate but tolerate? That's probably the most honest description of a competitive moat I've heard all year.
It is. It means the fear of messing up your data or retraining your whole staff is greater than the pain of the price hike.
The history, the payroll, it's all just too embedded.
Exactly. But this is where it gets really interesting because it's not just that one thing. You mentioned the Lollapalooza effect earlier.
Right, the idea that all these advantages compound on each other.
Walk us through those layers.
Yeah.
Because it's not just the lock-in.
No, it's not. It's why the business is so formidable. You have four forces all working together.
Okay.
First, the high switching costs we just talked about, the lock-in.
Right.
Second, the network effects. You have over 800,000 accountants who are pro advisors. They're an unpaid sales force that demands their clients use QuickBooks.
Forcing standardization. Got it.
Third, intangible assets. I mean, the TurboTax brand is just dominant. And finally, scale. With nearly $19 billion in revenue, they can outspend everyone on R&D for their AI, their GenoS system.
No startup can match that kind of spending.
So it's a magnificent fortress. But now we have to talk about the cracks in that foundation, the stewardship issues.
Yeah, and this is where it gets messy. It's like you're looking at two totally different companies. The brand sentiment it's a paradox.
How so?
Well, the data shows TurboTax is generally loved. People praise it. They say the live service is awesome.
But QuickBooks?
QuickBooks is just tolerated. The complaints are always the same: deceptive pricing, predatory hikes, and just awful, unresponsive customer service.
So their official value is customer obsession, but the behavior, especially with QuickBooks, feels more like customer harvesting.
It suggests they're cashing in on decades of brand goodwill to hit short-term numbers.
And that kind of behavior is almost always driven by incentives.
Exactly. And that brings us to the non-GAAP problem. This is the most critical piece of the puzzle for understanding management's decisions.
So their bonuses are tied to revenue and non-GAAP operating income.
They are.
Okay, so help us understand. What gets excluded from that non-GAAP number that encourages this kind of behavior?
Two massive things. First, it excludes the very real economic cost of share-based compensation. That's projected to be about $2.2 billion in fiscal 26.
Okay, we'll come back to that one. What's the second thing?
It ignores the amortization of acquired intangibles.
Which comes from?
The huge M&A deals. Think of the almost $20 billion they spent on Credit Karma and Mailchimp. The goodwill from those deals gets amortized, but that cost has zero impact on their bonus calculation.
So it's a recipe for empire building. They're incentivized to buy, regardless of the price.
It appears that way. But let's go back to the other piece, share-based comp, because this is so important. Why should you, as a shareholder, care if they add back $2 billion for stock comp? It's a non-cash expense, right?
Right. So why is it a very real economic cost?
Because it is dilution, plain and simple. When they issue $2.2 billion in new shares to employees, they're paying them by giving away a piece of your company. It's a quiet, constant leak of value.
It's like a slow-motion secondary offering every single year just to pay the bills.
That's a great way to put it. And when you look at the financial result of all this, the story becomes crystal clear.
The return on invested capital.
Yep. Intuit used to be a high-return machine. ROIC was over 20% back in 2020. After all this M&A driven by these incentives, it cratered.
And now it's sitting at what, around 15%?
15%. The bear case is that this lower quality, low return profile is the new normal. They traded a wonderful business for just a bigger one.
And the internal culture seems to be feeling that strain. Officially, it's a great place to work, but the anonymous Scuttlebutt is pretty shocking.
It is. Allegations of toxic leadership, using return to office as a way to quietly fire people.
And even claims that they managed their Glassdoor rating by deleting bad reviews.
It all points to a culture under immense pressure to hit those aggressive non-GAAP targets, whatever the cost.
Okay, let's pivot from the internal rot to the huge external threat, the big one.
The IRS Direct File Program.
Yeah.
A government-funded, completely free tax filing competitor.
Intuit lobbied against this for years, and they were successful. What changed? Why did the politics turn against them?
Honestly, they did it to themselves. Their whole free advertising campaign was seen as deceptive.
Right. It funneled people who qualified for free filing into paid products.
Exactly. And that resulted in a massive $141 million settlement. That scandal basically made Intuit a political villain and created the mandate for the government to step in.
And this isn't some startup that can run out of cash.
No. This is a permanent competitor with infinite resources and zero profit motive. It puts a cap on TurboTax's pricing power and will, slowly erode its user base over time.
That is a true existential threat. But to be fair, Intuit has the financial stability to fight this for a long, long time.
Oh, absolutely. The balance sheet is pristine. Stable credit rating, low leverage. It gives them huge capacity to return capital. They're doing $2.8 billion in buybacks, hiking the dividend.
But even their free cash flow number has a little asterisk next to it, doesn't it?
It does. It looks massive, over $6 billion. But it's significantly flattered by adding back that $1.97 billion in share-based comp we talked about.
So from a per-share economic value perspective, it's an inflated number.
It is. The dilution is real.
Okay, so last piece of the puzzle, valuation. The stock is never cheap. It trades at, 50 to 60 times earnings. Where is the margin of safety?
There isn't a quantitative one. The margin of safety is entirely qualitative. It's a bet on the absolute durability of that moat.
So the current price is assuming flawless execution.
Flawless execution for a decade. There is zero buffer for another bad M&A deal, for the AI strategy to stumble, or for the IRS to land a serious blow. You're betting they'll be even better than the market's sky-high expectations.
And for the bulls to be right, they need some clear catalysts to emerge.
They do. First, you need hard data showing that their AI agents are actually driving up average revenue per customer.
Okay. What else?
Second, they have to crack the mid-market with QBO Advanced. That's an $89 billion TAM expansion. And third, they absolutely have to turn Mailchimp around. It's still a drag on growth.
So let's bring this all together. You have this nearly impenetrable fortress built on switching costs and network effects,
which gives them incredible pricing power. But that fortress is now facing two major threats: internal rot from misaligned incentives and an existential attack from the outside.
which leads to the contrarian synthesis.
Right. The view is You're not buying a wonderful company at a fair price. You're buying a formerly wonderful, high ROIC company at an expensive price after management turned it into a non-GAAP roll-up.
While its main cash cow is, as you put it, being nationalized in slow motion.
That's the bear case in a nutshell.
It's a stark picture. Which brings us to the final provocative thought for you to take away. The core tension here is between the product's strength and the management's actions. So, think about this. If Intuit's fortress is so strong that it can tolerate the IRS threat and management's value-destructive incentives, does that make it the ultimate anti-fragile business? Or is that aggressive harvesting behavior a clear sign that they're exploiting the moat for short-term gain, guaranteeing a long, slow decay of the brand?